Taxes. Imagine you've just survived a rough month at work, grinding away flipping burgers at your local McDonald's. You're lying in bed when an email pops up. It says you earned $2,000. But when you check your bank account, only $1,456 actually shows up. You scroll through the pay stub. Federal income tax, state tax, Social Security, Medicare. This is the modern ritual of handing over a portion of your paycheck to invisible systems. And somehow, you're expected to smile about it. Here's the reality. Taxes are the price we pay to live in a functioning society. You pay, and the government uses that money to build roads, fund schools, make sure your favorite taco truck isn't crawling with rats, and occasionally send billion-dollar missiles to places you've never heard of. But not all taxes are the same. There's income tax, which takes a cut of what you earn. Sales tax, which hits you when you spend. Capital gains tax, which targets the money your investments made while you were sleeping. One way or another, the government takes a slice of nearly every dollar. Almost everyone also pays Social Security tax and Medicare tax. Social Security is basically the government forcing you to save for retirement. You're required to put money aside now. And later, when you retire, it gets paid back to you over time. Medicare, on the other hand, is a healthcare tax that helps support older adults and people with serious medical conditions. Then comes filing your taxes. And yeah, it's weird. The government already knows how much you owe, but it still makes you do the math yourself. If you guess correctly, great. If you mess it up, you're in trouble. As for paying taxes, some people pay every few months. Some people pay once a year. And then there are the people who don't pay at all and end up starring in documentaries. Taxes are definitely frustrating, but they're not pure evil. Countries with higher tax rates often enjoy a higher overall quality of life. Banks. You walk into a bank, hand the cashier your money. They count it, smile, and tell you it will be added to your account. You walk out thinking, great, now it's sitting in a vault somewhere being guarded by a dragon. But in reality, that money is already gone. Most people think of banks like a giant safe with only one job, guarding people's money. But that's not what they really do. Banks are just middlemen. They're matchmakers for financial transactions. When you deposited $1,000, the bank took about $900 of it and gave it to someone who wants to buy a jet ski. That system is called fractional reserve banking. It works because banks only need to keep a fraction of the money on hand. They assume not everyone will show up at the same time trying to withdraw 100% of their account. Unless it's 2008, of course. That's when people lined up to withdraw everything they had, and the entire system started to collapse. So how do banks make money? Simple. They lend your money at a higher interest rate than the interest they pay you. That's it. You are the supply of money. The borrower is the demand. Banks convince you to deposit your money for a few reasons. First, it's easier and more convenient to use a card or transfer money than to carry cash everywhere. Second, they literally pay you to keep your money with them, in the form of interest. And third, your money is much safer in a bank than in a shoebox in your room. In the United States, most banks are insured up to $250,000 per person. That means no matter what happens, the government guarantees your money, up to $250,000, is safe. Interest. You borrow $1,000, but you have to pay back $1,280. Why? Because of interest. Interest is money's way of charging rent to exist in someone else's hands. When you borrow, interest is the price for using someone else's cash. When you lend or save, interest is the reward for being patient and, honestly, a little boring. There are two main types. Simple interest is like, here's a flat fee, thanks for playing. Compound interest is different. Every dollar you gave now has clones. And those clones also want rent. Let's say you owe 20% interest on a credit card. You miss a payment. Now your interest is earning interest. Pretty soon, your $12 burrito turns into a $50 regret. On the flip side, investing at 7% annual compound interest is your money duplicating itself like a cheat code. $100 becomes $200. then 400. Then one day you wake up, you're old, rich, and just a little smug about it. This is why interest is the silent engine behind both wealth and debt. In loans, it's the slow burn that turns small mistakes into financial fires. In investments, it's the time bomb that turns small gains into massive wins. So what's the hack? If you're paying interest, kill it fast. If you're earning interest, let it sit. Feed it. Give it time. Interest is either your worst enemy or your best unpaid employee. The choice depends on who's collecting it. Inflation. You buy a bag of chips, you open it up, and it looks like it's already half-eaten. Then you check the price, 30% higher than last time. That's when you realize you've just been hit by inflation. Inflation is what happens when money slowly loses value over time. Not overnight, not with fireworks, just a quiet, steady erosion. Your $5 bill is still technically $5, but it buys less instant noodles, less gas, and less of everything else than it used to. So what actually causes it? Sometimes people just have too much money. Everyone's got cash. And everyone wants the same stuff. Imagine 2,000 people want a $500 TV, but the store only has 1,000 TVs to sell. So the business thinks, everyone wants this TV. That'll be $800. Other times, inflation comes from supply chain problems. If it costs more to produce something, the price of that thing has to go up. And sometimes, inflation happens just because of expectations. If people believe prices are rising, they spend more now. That pushes prices up even faster. It becomes a self-fulfilling prophecy. A little inflation is normal, even healthy, about 2% a year, predictable. But when inflation spikes, savings lose value, and wages fall behind. To fight inflation, governments raise interest rates. When interest rates go up, borrowing becomes more expensive, people pay more interest, and they have less money to spend on things like TVs. Spending slows down. The economy cools off. Recessions. A recession is when the economy shrinks for at least 2 quarters, or about 6 months. In simple terms, one day, everything feels fine. You have a job, your bills are paid, you might even be planning a family trip. Then suddenly, layoffs start happening. The stock market only goes down. In a recession, jobs disappear. Companies cut costs, and people start saving money for necessities instead of buying things they don't really need. So why does a recession happen? It can be a lot of things. High interest rates can make borrowing too expensive. A global crisis, a war, a pandemic, even a rogue container ship. Or sometimes it's just the economic cycle doing what it always does. Boom, peak, bust, reset. Think of the economy like a party. During the boom, everyone's dancing, drinks are flowing. But eventually, the lights start flickering. Reality sets in. Someone checks their bank account. And suddenly, the DJ is playing sad lo-fi beats about corporate downsizing. Recessions don't last forever. They're resets, painful ones. Governments may lower interest rates. They might send out stimulus checks, or just hope people start buying overpriced coffee again. Eventually, spending returns. Businesses rebuild. Growth resumes. But not without scars. Credit scores. A credit score is a shadowy algorithm that knows your name, your past, and how many times you paid your credit card late in college. It's a 3-digit number that decides whether you get a house, a car, or a soul-crushing 27% interest rate on your new TV. This number isn't about wealth, it's about trust. Lenders want to know, if I give this person money, will they actually pay me back? Credit scores usually range from 300 to 850. Below 580, you're a walking red flag. Above 750, you're glowing with adult credibility. Most people sit somewhere between 640 and 790. So how is a credit score calculated? First, payment history. Do you pay on time? This one matters the most. Second, credit utilization. How much credit are you using compared to how much you have available? Third, credit age. How long have you had your accounts? Fourth, credit mix. Credit cards, loans, mortgages. A little variety helps. And finally, new credit. Too many recent applications can hurt your score. All of these factors go into the calculation, but to actually improve your score, you need to make every required payment on time, before it's considered late. Once a payment is late, your score drops. Think of your credit score like a pet dog. Ignore it, and it messes up your entire life. Take care of it, and one day it might help you buy a house. It's not about being good with money, it's about looking good to lenders. You can have zero debt and still have a terrible score if you don't have any credit history. So yes, the game is rigged, but if you learn the rules, you can rig it back. Currency. The strange thing about money is that it isn't actually real. Humans created money to make the world work better. It makes trading easier. It makes it easier to build systems and to organize society. That said, there's no real difference in legitimacy between a dollar bill and a Bitcoin. People believe a dollar bill has more value, and maybe it does, for now. But only because people believe it does. The same logic applies to a dollar bill and a stick. The only reason a dollar bill can buy something and a stick can't is because we, as a society, have agreed that the dollar has value and the stick does not. So how does money actually work? The government prints it. Central banks regulate it. And everyday people trade it in exchange for goods and services. Banks have to regulate money because if the government prints too much of it, inflation takes over. And suddenly everyone's money starts to feel like monopoly money. But if there's too little money, people can't afford to live. Currency, or money, is a social construct built entirely on shared belief and trust. Investing. You know what inflation is now. And the best way to fight inflation so your money doesn't slowly lose value is investing. Investing is what happens when your money stops sitting still and starts working for you. Instead of trading your time for money, you're trading money for more money. The catch is, there's risk involved. So what can you actually invest in? Stocks. Small ownership slices of companies. If the company grows, your slice becomes more valuable. Bonds. You're basically lending money to a government or a company. They pay you back with interest. Funds. Collections of stocks and bonds so you don't have to pick everything one by one. Real estate. Property you hope someone else keeps paying to live in forever. There are other investments too, but these are the main ones. Investing isn't about getting lucky. It's about being early, diversified, and patient. Most wealthy people didn't win the lottery. They just gave compound growth 30 years to do its thing. And yes, investing comes with risk. Markets go up, markets go down. But the real danger isn't losing money. It's never investing at all, and letting inflation quietly steal your future. Value. This one is more complex, but everyone should understand it. Imagine you pick up a rock. It's just a rock. Now imagine that rock is shiny and yellow. That's gold. Gold is rarer than an average rock. So we place a higher value on it. Gold isn't actually more useful than a normal rock. It's only worth more because humans decide it is. Understanding this is what allows people to become rich. If you provide a lot of value, you earn a lot of money. Steve Jobs created the iPhone you're probably watching this on right now. He created something with massive value. So millions of people gave him thousands of dollars in exchange for that value. It's the same reason doctors and lawyers earn so much money. The value they provide is high. And people are willing to pay a lot for that service. Value is also why Gucci or Louis Vuitton can sell a handbag similar to one from Target, but charge 100 times more. People perceive it as more valuable. So it is. If you can figure out how to create value, even if it's perceived value, you can make a lot of money. Time. Time is the most valuable asset in the world, and the best part is, almost everyone starts with a lot of it. You probably still have plenty left. But no one gets an unlimited supply. Most people work jobs where time is traded directly for money. 1 hour, 1 paycheck, simple math. Top earners figured out how to make their time worth millions. And the difference isn't magic, it's skills, leverage, and how well you've trained your hours to work for you. But nowhere does time work harder than in investing. There is no greater force in building wealth. Not luck, not income, Time. Because wealth isn't built in days, it's built in decades. Money that sits quietly inside an investment doesn't just grow, it multiplies. Slowly at first, then faster. That's why ordinary people with modest paychecks can retire with 7 figures. They didn't beat the system. They used the system. A little money invested consistently and given enough time becomes a lot of